Welcome to the Business Finance Matters podcast. Over the next 15 minutes, we're going to tackle some of the topics that we get asked about on a regular basis so you business owners can get a better understanding of what it is that you're probably dealing with on a day-to-day basis. Let's get on with it. Trevor, interest rates. This is a topic that comes up time and time again. We see it a lot on LinkedIn, for example. A lot of conversation goes up there about interest rates, in particular some of the lenders. But we won't go into that so much today. But in terms of your understanding of interest rates, it's a smorgasbord of information, isn't it? There are so many different types of interest rates, whether it's APRs, flats, yields. I mean, the list is endless. So from a business owner's point of view, how the hell do they get their head around that?
That's a good opening question. I mean,
Thank you.
You're absolutely right. I mean, where do you start? I mean, you've worked in the industry. I've worked in the industry for, donkeys. And yet we probably don't understand what everything means. I think the place to start with interest rates, it's got to be remembered that lenders are in business to make money. Yep.
Absolutely.
That's the starting point. And it's a strange concept, but lenders don't just have vaults full of cash that they dish out in big brown envelopes. They borrow money themselves.
Correct, yeah.
But they borrow vast amount of money. Or, in some instances, when you look at the banks, they're lending their deposit takers money.
Mm-hmm.
So there's generally two ways that they fire up. And then don't forget, before they even start getting into the realms of actually making any money, they've got to cover their costs. So they've got the costs of money, because wherever they've got the money from, they've got to pay that back. They've got operational costs, running staff, running offices, and et cetera, et cetera. So just remember, I think the good starting place is to remember that lenders have costs they have to cover.
Yeah.
They also have to pay that money back from where they've borrowed it from. So that's the starting point.
Good point, yeah. So if we look at it from a business point of view, it's a business model. Lenders lend money for obvious reasons, but they have to also make a return on that, just like any business.
Yeah.
Then I think where the grey area tends to come around is when business owners, or even us as individuals, look at something, whether it's your credit card or whether it's something that you're borrowing, whether it's asset finance or loans, you look at the interest rate, and somewhere within that mind, you're trying to work out, is this a fair interest rate? And the word fair is something that crops up a lot, isn't it?
Yeah, I mean, it's interesting. I mean, you mentioned credit cards there. That's one form of borrowing. There's overdrafts, there's loans, there's mortgages. Yeah. We hear all these products. We know what a lot of them do. We know what a lot of them say. But what you got to bear in mind, there is a correlation between, remember what I said, that a lender is there to make money. One of the key considerations is not so much the interest rate, but the term over which they're prepared to lend you that money. So we've talked, haven't we, on many times in the past, short-term borrowing could be considered expensive. But let me give you an example. If you said to me, "Oh, Trev, I'll give you 100 quid for a month. Yeah, just give me 110 quid back next month." I'll probably go, "Yeah, well, that's fair." I'll go 10% for 10 quid for 100 quid. No skin off my nose. Mm-hmm. But if I had to do that every month, I had to pay you £10 every month for a year, it suddenly becomes very expensive, doesn't it?
Yeah.
So what lenders have to do, they have to measure a lot of things. They have to measure the risk. Are they going to get paid back? What term are they lending that money, and when do they expect to get that money back? And what profit margin they're wanting to make on that. And don't forget what I also said, they've got all those costs, and one of the costs they've got to bear in mind, a bit like insurance, I'm afraid, but they've also got to try and guess what proportion of bad debt they're going to carry, because not everybody's going to pay them back, I'm afraid.
No. I think most business owners would recognise that the model of lending money has a cost to it.
Yeah.
We can go on to this now if you want. There are so many names associated to interest rates.
Yes.
APR is probably the one that everyone's familiar with.
Yes.
The list is long. It's a bit like a bag of licorice, all sorts. We've got APR, we've got yields, we've got flat rates. I mean, the list goes on and on and on. So in the general formula of businesses looking at what cost is associated to that particular debt finance, what typically would you expect to be seeing so that we could explain it a little bit more?
I think sometimes the words, you've just done it yourself. You've just listed a whole different way of calculating an interest rate. I think what's happened is that it's actually not served. APR, I'll give you an example, came out many, many years ago. I think it was an OFT calculation, Office of Fair Trading, which preceded the FCA. And I've seen the book to calculate an AR, and it is a book. It's about a 1/4 inch thick. That's how you calculate. What the intent of it was, and it's particularly relevant in the supermarket, was to try and enable people to compare the costs of different forms of borrowing. But the reality, unfortunately, is that it just serves to confuse people. How do they know whether it's expensive? How do they know whether it's fair? How do they know whether it's cheap, or well-priced or whatever?
Yeah.
I think one of the biggest things I would always say to someone, you probably need someone like yourself to get involved here, particularly in business-to-business lending, is to actually break down everything, And I know it's old-fashioned, but sometimes a pen and a piece of paper, and go, right, how much am I borrowing? How much am I paying back? And something we haven't mentioned yet, what are the fees? What are the fees of entry? What are potentially annual fees? What are exit fees? What are my options? And it always goes back to what you say, Dave. It is, what's the best fit for me at the moment?
Okay. So as an intermediary, business finance professional, this is something that comes up on a regular basis.
Correct,
So when we're
yeah.
talking to a business owner and we are considering what type of business finance product to introduce to the business, part of that process is the cost. And that cost, as you quite rightly said, is a combination of interest rate, fees. Maybe there are, in some cases, there are documentation fees as well as, from an intermediary point of view, we get paid a fee as well. So my role, or any member of the guild's role, is when we're looking at the product that we're considering introducing to the business, we'll make that very clear as to where we are in terms of cost. And I use the word cost because that includes, as you quite rightly said a minute ago, the interest rate, the fee, any other types of costs that are going to go into that, but we break it down.
Yeah.
And there are circumstances, and this has come up quite a bit again, especially on LinkedIn, where there's a lot of criticism going around about these high interest rate, short-term lenders. And I think, I'm not necessarily defending them, but I think they get a bad rap from time to time. And I have situations where I will use a product that is short-term, and in the eyes of, say, a layman, they might consider that as a high rate of interest. But when I, as a business finance professional, break that interest rate down and I explain to them, as you quite rightly said, if you're looking to take on cash flow is a great rationale for why I would introduce a short-term product.
Yeah.
If you only need something for 3 months, okay, and the cost for that is going to be, I don't know, circa 3, 4, 5% per month. So over 3 months, you add that up, that's 15% or whatever the calculation is. What I try and explain to the business is, hang on a second. Okay, that's the cost. Now, if you are going to pay that off over 3 months, but the value of having that cash in advance is going to bring X, Y, and Z benefit. And by the way, if you pay it off earlier, the interest rate or the cost comes down.
I think you hit the nail on the head there, because we often refer to the barroom conversations, don't we? You got a business owner, my mate down the pub said, that's expensive, or this is, well, hold on a minute. If you're just going to pluck a number out of thin air, expensive compared to what?
Exactly.
When you start hearing people talk about APRs, it's 100% APR or it's 50% APR, that's not the whole story. No. Sure, if that was a mortgage over 25 years, we all know, everyone knows that would be expensive. Mortgages are in single with barely double-digit APRs. But if you actually then sit down with a pen and paper and work out how much interest you're paying over that 25 years, you actually think...
Correct. If you use your mortgage as an example, mortgage rates are fairly competitive, aren't they? But over a 35-year period...
Correct.
And this is the point I'm trying to make. The cost of finance is relevant.
Yes.
But that figure, whatever that figure is,
yes.
10%, 15%, whatever it is, we have to make it very clear to the business owner that this is a cost that A, is going to benefit you, and certainly in terms of best fit, as we keep talking about, this is the right fit. And once you break it down or you annualize it, whatever language you need to use for the business owner to understand it, that's the most important part.
You're spot on again. I mean, I mentioned very early doors, it's term, isn't it? The term is important. Are you borrowing it over 3 months, 3 years, 30 years in terms of a mortgage? What is it? But you cannot beat, Dave, you cannot beat someone like yourself, or a member of the guild, for example, which we support and they support us. You cannot beat someone just taking you through it step by step. What are the fees? What are the penalty fees? Don't
As
forget
in,
them.
when you say penalty, you mean if someone was to end the term earlier than...
Not so much that. I was thinking more if they missed a payment or if they bounced a payment or something like that.
Okay.
Or I can't think of any other example at the moment, but are there penalty fees? Are there early termination penalty fees? And I think the value in literally... what we're trying to do here, and I'm going to bring it up, what we're trying to do here is we're trying to explain to business people in their language. The problem is when you start going in and talking about most people, you've come across it, business owners go, oh, well, what's the rate? Well, what rate do you want? Is it a monthly rate, actuarial, is it nominal, fixed, flat? What do you mean by what's the rate?
That's a good point. And this is something I come across. Businesses always seem to, for whatever reason, again, it's natural because it's our human reaction to anything that costs, whether it's fuel prices or energy prices, but what's it going to cost me?
Yeah.
And I always, personally, I don't go and start with cost. I start with what is the product that we need to help your business get access to. And we've gone through this before, the number of products, whether it's leasing, invoice finance, loans, and then the cost comes into it. And I try and explain to them that, like with everything, there's a cost, and this is the rate. Very rarely have I had situations where a business has turned around and said, I'm not doing this, it's too expensive. There have been a couple of times, of course, but overall, once you have broken it down. But I'm conscious of time. But with interest rates, so for example, if we look at, I'm doing something at the moment where there's an overdraft facility, and there's a loan facility as well, but there's things like fixed rate and there's variable rate. And I think most people understand what that actually means, but the same thing applies. So with the customer I'm dealing with at the moment, we're looking at potentially doing a variable rate because economic forecasts are saying interest rates are likely to stay the same, if not go down.
Yeah.
But that's a bit of a gamble as well, isn't it?
Yeah, it's a hedge, isn't it? Yeah, it's a bit of a hedge. The key thing for me, Dave, is and we've mentioned it a couple of times here. Let's even go back from that. What's the purpose? What is it you're looking to do? When's that event likely to happen? So, for example, are you buying a digger? Are you buying a truck? Are you buying a van? Well, you ain't going to keep a van for 5 minutes or 3 months. Or are you looking to expand, or are you looking to purchase more property? Are you looking to take on more staff? Or is it more cash flow? Is it you've got a contract coming in 6 months' time, but you need to service that contract? You need to buy raw materials. Once that contract's signed and the invoice is paid in 6 months' time, you're in the money, So you've got to understand, people have got to understand what it is, the purpose of that money. And as we keep saying, they ain't going to get that from the interweb. They need to speak to a business professional like yourself or someone in the guild that will take the time, the effort to first and foremost understand what that business is looking to do. Once they understand that, then they can match the product to that situation, and it will be and have an appropriate interest rate that satisfies everybody, not just the customer, but the lender too. Because like I said right from the beginning, lenders are not charities. They need to make a profit. They've got costs to cover. And that is why sometimes they're misinterpreted, particularly in that short-term market space, as being expensive compared to what?
I feel like I'm down the pub now chatting away to you about interest rates. Because
I'd murder a pint right now.
But look, I think we need to summarise, we always go back to the obvious, which is interest rates, whatever type of financing questions or clarity or guidance is needed.
Yes.
Just go through a member of the guild to make sure you're given the right guidance, and they'll break it down. Yes, it's a cost. Is the cost worthwhile? Is it something that you're prepared to consider and accept? And as an intermediary like myself, we'll always make sure that's broken down.
You're spot on. Don't forget, every business customer you talk to, they're in business to make money too. So they understand that concept. It's not always, it's not always let's get the cheapest interest rates we could possibly find. Well, who's to say the product's right? But you're absolutely right. Yeah. You need guidance. Business owners do not get involved in this market on a day-to-day basis.
Okay. Where do they go for more information, Trev?
Well,
website?
They could go to the website, bfpguild.org, which is the guild website.
And I can do the email. I think I remember it now. It's in the camera here, podcast@bfpguild.org.
Blimey, mate.
Did I look like I was reading that?
Blimey, mate. You're improving, aren't you? Good grief. Mate, it's good to see you. Unfortunately, I can't make the pub. I've got a flat tyre in my car at the moment. I've got to sort that out. But good to see you as always.
All right, take care. Thanks for joining us on this podcast. We hope it was useful. Please share, please subscribe so we can share this content to as many business owners as we possibly can. And if there was anything we haven't covered in this particular episode, then please let us know. Drop us a line. We'll be happy to talk about it in future episodes. Thanks again.